Today I am going to speak on project financing. As you know that project financing is an important and crucial part of project management that entirely determines and defines the quality of project management and the goals to be achieved. Now the structure of this lecture is it will be covering objectives, source of long-term financing, debt financing, equity financing, short-term sources for working capital and newer sources of finance. After studying this unit, you will be in a position to number 1, understand the different sources of long-term finances available for the project. 2, know about debt financing, equity financing and other financing sources. 3, understand the various institutions advancing project loans. 4, explain the venture capital financing and the process involved. And last, 5th, know about the short-term sources of working capital. Now, about the sources of long-term finance, it has got 3 components: debt, equity and new modes. Debt has got 2 components, one is loans, the other is debentures. Now, equity financing has got 3 basic components: preference shares, equity shares and retained earnings. Now, let us have a look into what you call your debts. It has got loans, first one, already I have told you that, loans and debentures. Now, keep on talking about loans. Loans are number 1, sources of loans are central financing institutions or development banks, state financial corporations or SFC, state industrial development corporation SICDS and commercial banks. Private financing and international financing institutions. What about debentures? Let's have a discussion on debentures. What is debentures? Debentures are loans that are usually secured and are said to have either fixed or floating charges with them. They are different from loans, as loan is provided by a bank or an institution, whereas debenture is funded by public or group of people. Now, equity financing, although owners of equity instruments are the owners of a company, it is actually equity shareholders who are the real owners of the company. There are various sources of equity financing. First one, preference shares. Second, equity shares, and third, retained earnings. Now, what is preferential shares? Preferential shares offer their owners preferences over ordinary shareholders. There are 2 major differences between ordinary and preference shares. 1, preference shareholders are often entitled to a fixed dividend even when ordinary shareholders are not, and preference shareholders are normally vote at a general meeting. Now, let us have a look into equity shares. Equity shareholders are the true owners of the company. They have the voting rights and right on all the remainder's profit after paying interest to debt and preferential dividends. Who owns Reliance Institutions? Mukesh Ambani? No, my dear friends. He is just holding majority stake of the company, and so he is controlling the company. All shareholders of Reliance Industries are the owners of the company. The equity shares are generally not subjected to buyback, and under no circumstances can be an equity shareholders be forced for buyback. Now, what is retained earnings? It is interesting to see that retained earnings is the cheapest of equity source of capital. Companies do not declare dividends equal to their earnings. They retain some portions of their earnings for various reasons. One of the major reasons is future prospect. Such reserves are used as source of funding of a new project, generating the case of brownfield prospects you just see. Now, short-term sources for working capital, another very important part of project management. These sources of fundings are funding for a short-term working capital. Now, let us take a look. The various short-term sources of funds are cash credit limit or overdraft, commercial papers, Hundis, factoring and trade credit. What is cash credit limit? Overdraft by the banks. Let's say this is a form of loan provided by a bank. This is a cheaper means of fund as interest is payable on the amount which is withdrawn on a particular date. Mind that it has to be withdrawn on a particular date. And commercial papers, what is commercial paper? Commercial paper is an unsecured short-term debt instrument issued by a company, typically for the financing of accounts receivable, inventories and meeting short-term liabilities. Hundis, it is a very traditional ancient source of financing for short-term funds. A firm needing short-term funds for meeting its working capital needs to raise the funds privately at a predefined rate of interest through money market. This is generally dependent on the goodwill earned by the borrower. Mind that goodwill is the paying concern on which hundis are performed. Now the another is factoring. What is factoring? It is a financial option used for the management of receivables. Trade credit. Firms do take advantage of the goodwill during purchasing goods on a credit, thus reducing working capital requirement. Many firms also take deposits from the distributors, which in turn provide them funds for working capital. Some firms also sell their product after receiving advances, which also provide funds for their working capital requirements. So trade credit plays the role of yeoman services. Now newer sources of finance are coming up, basically on the international financing. The International Finance Corporation IFC, the Multilateral Investment Guarantee Agency MIGA and the International Project Financing Agency IPFA give loans to promote private sector, corporate investment in developing countries under the theory that such investment will provide economic growth. In a new world order, when their global financing becoming a reality, so the role of newer sources of finance are coming up in a swashbuckling way. Now leasing, another important area of short-term financing, you know that, a new mode of financing rather. Lease is an agreement between two parties, the lessee and the leaser. The leaser purchases capital goods for the use of the lessee and the lessee uses it by payment of predefined rentals. The lessee continues to be the owner of the asset. Leasing is generally used for financing capital goods. Now hire purchase, it is a form of installment credit. Hire purchase is similar to leasing with the exception that ownership of the goods purchased by the hire purchase customer as soon as the financial installment is paid, whereas a lessee never becomes the owner of the goods. Mind that a lessee never becomes the owner of the goods. Venture capital financing is also coming up, another feature of new mode financing. Venture capital is the capital provided by outside inventors for financing of the new, innovative or struggling business. Venture capital investment generally a high risk investment but offer the chance for above average returns. A venture capitalist, also called that angel investor, is a person who makes such investment. The process, what is the process through which venture investment or venture capital are coming up? Number one, deal origination. Deals may be referred to the venture capitals through their parent organization, trade parents, industry association, friends, etc. There are various consultants like McKinsey conduct quiz and competitions to search out novel ideas. They are organizing quizzes, that is called brainstorming, to generate and eke out what are the different deal organizations and what are the processes coming out. Preliminary screening. After being done, preliminary screening is being organized. Venture capitalists carry out the initial screening of all projects on the basis of some broad criteria like investment, risk, technology and market scope. Now due diligence, it is there. Due diligence is that this is the step of detailed evaluations of the proposals. There are various criteria, but there are 11 guidelines given by Dr. I.M. Pandey from IIM Ahmedabad. Integrity, urge to grow, long-term vision, commercial orientation, critical competence vis-a-vis venture, ability to evaluate and react to risk, well thought out strategy to remain ahead of competition, high market growth rate, expected return over 25% per annum in 5 years, managerial skills and marketing skills. Mind that 11 magical skills will be there to conduct a due diligence. Now exit. Venture capital fund is not a permanent fund. It has to withdraw after a particular period of time, 5 to 10 years. Mind that, 5 to 10 years is the critical period. And there are various ways to exit. The most common way is IPO, initial public offer. Some others are the investing company repurchase the shares, or shares are sold to a third party, or the firm itself is sold. Deal structuring is there. After evaluating the project, it is time to finalize the terms and conditions for the deal. The venture capitalist and the investment company negotiate the terms of the deal and decide the terms. I want to have a quick fire round. That is what you call the financing, project financing. That is the most important part, and you have to go carefully. Second is that you have to take care of the long-term finances, the short-term finances, and new mode of financing. And you have to make a difference between what are the debentures and the loans, and you have to make what kind of deals can be there, and what are the new world of economic ventures that are coming up. Then before closing, we can take a reminder of the basic components of project finances and some of the area to be concerned with. Firstly, the sources of long-term finance. We have already discussed in terms of debt, equity, and new modes. These are the three basic long-term finances are coming up. But now one has to be careful. What is a debt, what is equity, and what are the new modes of financing? Debt is basically the liability of the project stakeholders basically, and equity provides the scope for the participations of the project stakeholder, and new modes of finance are providing you a global arena for drawing your project management and project financing with a new scale and height. Now, some of the few things that you have to consider while you are taking the loan, you know that loans again can be short term, mid terms, and so on. But mind that you have to pay interest for the loan. Your break-even quantity and your net return must be enough higher to repay the loans. And what about debentures? Here the stakeholders are participating into the project financing and project management part. So one have to be very much careful whether the debentures can be protected duly and with adequate returns for the supporting stakeholders. Now another important thing for the equity financing is that preference shares are there, equity shares are there, and returned earnings there. In a returns earnings, you can find some opportunity because some of the earnings are retained by you. But while you are talking about equity shares and preference shares, you know that in equity shares, the equity holders, they are participating in contributing and voting rights are there. And preference shares are also there where dividends are being preferred by the stakeholders. So equity financing also has got a tremendous contribution in project financing. So getting out of the arena of debt and loans, you can enter a new arena of equity financing. And while we are talking about that, these loans or equity financing or debts whatsoever, these things are coming in a new global order. I am just referring to the Joseph Stiglitz book that you know that globalization, the concerns are there. He has highlighted that in a new global order of economy, the emerging economies has to accept the challenge. At the same time, there is the fear of that in the global competition you may lose the ground. No fear. In a strong project financing ground and background rather, you can fight the global challenges. You can't get your project deterrent of global impact. At the same time, you don't ignore the fiscal prospect. So there can be a symphony between fiscal prospect and the global prospect. Yes, project finance can provide a synchrony between synchronization between what you call your internal fiscal prospect by exploiting your fiscal market. At the same time, we can jump out to harvest the benefit of global market. And thanks to project finance, it would help you a new vision how best you can have a merger between debts, liabilities, and at the same time stakeholders' participation in project finance management in the form of equity, shareholders and new modes of financing. If there is any further doubt, just contact Manage, and I think any doubts to be made clear. Till then, we can expect a very brilliant zenith of project financing that will make you a champion in the area of project management. Thank you. Goodbye.